Most first-time investors who fail don't fail because of the property they've selected, but they fail because they didn't have a proper financing strategy in place at time of purchase. Buyers often overestimate how much they're going to qualify for, underestimate their overall monthly mortgage obligation, and overestimate how much they can reasonably expect to collect and rent on a monthly basis going forward. And that often leads to success being very difficult to achieve. Understanding your financing options prior to going into purchasing a property and having a specific strategy for that property in place is imperative. Knowing exactly what you qualify for and what your options are going to help you narrow down the properties that fit your overall goals and properties that make sense for you. So, knowing exactly what your financing strategy is sets you up for success long term. If you're someone who's considering buying a rental property in the next year or so, or even someone who's just considering whether or not owning a rental property is right for you, you should find this video very helpful in your decision making process. Many times, first time investment property buyers end up failing with their mortgage financing because they didn't get fully pre approved prior to starting the shopping process or going under contract. Working with a mortgage broker who you know, like, and trust that also knows exactly what your overall long term and short term goals for investing is critical. Also, understanding that interest rates, debt to income ratios, and many other factors or hurdles in your overall qualification process and understanding how those affect you specifically is important. Understanding what a lender looks for in terms of a full application is also important. Lenders are going to look at your overall housing history, your overall employment history, your overall credit, income, and asset history. Having a stable history in all of those categories increases your odds for success initially. So, understanding your qualifications prior to going under contract and going over those qualifications with your lender is imperative. Investment properties typically require anywhere from 20 to 25% down payments. Sometimes you can get away with a little less, 15% in some cases, but most of the time, in order for a property to properly cash flow in terms of your goals and needs, but also for loan approval, you're going to be looking at 20 to 25% down minimum. Also, you need to understand that investment property financing often comes with slightly higher interest rates than what you're seeing advertised out in the market today. Typically, those rates are higher by anywhere from a half a point to a full point or more in terms of interest rate. The reason interest rates are higher on investment properties is strictly due to risk. So, understanding that and factoring that in up front, working in concert with your mortgage broker will only set you out yourself up for success going forward. Also, lastly, understanding exactly what your overall expenses on the property are and budgeting out a proper reserve is imperative. I recommend at least 6 months in reserves for a first time investment property buyer, not only because in most cases conventional loans are going to require that, because it sets you up with a cushion that you can accurately rely on in case issues pop up in terms of maintenance that you have to deal with, or maybe you have a tenant who moves out unexpectedly and you're left searching to replace that tenant, and it may take more time than you expected going forward. Lastly, understand how rental income qualifications and rental income and your numbers can impact your overall decision making process. When a lender using conventional financing and most other programs looks at rental income, they don't just take the amount that it is expected to rent for. In most cases, a vacancy factor of 25% is applied. So if you're renting a house for 2,000 a month, a lender is probably only going to allow you to count 1,500 of that on a monthly basis towards your overall qualifications. But in terms of your understanding how rental income is going to impact your numbers, you need to also understand that you're not always going to receive 100% of the rental income you're expecting going forward. And budgeting for that up front is just as important as understanding your overall loan terms. So, again, Understanding the basics of what you qualify for and how that affects your overall purchasing and financing strategies is important to be successful in that first time purchase. Thanks for watching part one today of why most first time investment property buyers fail with their financing strategies. If you like the information presented today, make sure you tune in next week where we'll be talking a little bit about potential loan options available to you, as well as how to determine the best overall financing strategy for your individual goals going forward. If you found the information presented today helpful, please make sure you hit subscribe and tune in next week as we wrap up this series. Also, if you'd like to ask any questions or maybe book a strategy call with me, shoot an email to me at askstevemolman@gmail.com. And don't forget to ask about my first time investment property buyers checklist. Thank you.